Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking big picture for markets, for investors broadly on the shift or at least upcoming shift in Fed policy, other central banks around the world, and try to make sense of how these markets have continued to run higher when we have heard from a few commentators that look like everything is priced for perfection here. These markets are due for some sort of a pullback, if not major correction. All good topics for us to cover here as we are chatting with Jesse Felder, founder and editor of the Felder Report. Now, Jesse, just recapping last week's Fed meeting. Look, the Fed is sticking to their guns of saying they're going to be cutting rates 3 times this year, 325 basis point cuts. Even if inflation doesn't get down to that 2% target level, they're not even expecting it down to that 2% target level until a couple years out from here. But they're going to be cutting rates. Maybe that's the major driver behind this continued market rally. What was your takeaway from the Fed meeting, statement, and Jerome Powell's press conference last week?
I think it's very clear that they're backing away from a firm inflation mandate, and I think that's very important development for markets. Mohammed El-Arian wrote an editorial for the Financial Times today, basically kind of elaborating on that theme. He said, it would not surprise me if future economic history books were to look back at last week in central banking as marking a move away from strict inflation targeting. That's a pretty big deal for the global central banks led by the Fed to publicly basically say, we're not going to, and it's a dramatic 180-degree shift from what Jay Powell was saying even 6 or 9 months ago, which was, we are determined to bring inflation back to target. That was not the Jay Powell we saw last week. The Jay Powell we saw last week was inflation looks like it's trending in the right direction. The risks are balanced, but we're not really in a hurry to make sure that it gets back to target. And so I think that's pretty clear that the Fed is willing to tolerate above 2% inflation for a prolonged period of time. And that's in their forward guidance and all of that.
Well, Jesse, it is interesting because if you go back, like you say, 6 to 9 months or even a year ago, there was a lot of the Fed officials that were saying we've got to see it not just get to 2%, but stay there for a reasonable period of time to know that they've tamed inflation. And now the narrative has shifted to, well, it's a lagging factor, so you got to go ahead and get moving on it ahead of time. You had some interesting points about that yes, there's a lag effect to rates policy and monetary policy, but that this has been a pretty extreme loosening event after a very extreme tightening event.
Yeah, and so one of the Fed's most important tools is not just moving interest rates and quantitative easing or tightening, it's forward guidance of policy. And so the pivot in that forward guidance that we got several months ago, where the Fed said we're probably done tightening and we're going to start the risks are more balanced. This was 3 months ago or something, and we're going to start having to look at cuts. From that point, the stock market has rallied off of its October low, very strongly over the last 5 months. Corporate spreads have narrowed significantly, and that has resulted in the most rapid loosening of financial conditions on record. And so this has a very important effect on the economy, right? The Fed really hasn't done anything other than dramatically shift its forward guidance of policy. But that shift was enough to move markets, and so move markets in a dramatic way. And so when stock prices go up, it makes consumers feel a lot better about the economy and things, so they spend more. Corporate spreads are narrowed so that corporations can refinance easier. All of these things kind of go into in a reflexive way into supporting the economy. And so I think that that's one of the things that really opens the door to an inflation, a prolonged inflation problem. It's not just the fact that the Fed has very clearly communicated now that they're not committed to returning inflation back to target anytime soon. suggests that there's a real risk to inflation in the months ahead. Now, you pair that with the rapid loosening of financial conditions that we've seen, and then the signs, in January, February, that CPIs come in hot. And I think you start to understand why things like break evens, 1 and 2 year break evens, are showing that inflation expectations, and at least market based inflation expectations, are on the rise.
You're right. We have seen people assume that inflation is going to stick around that higher for longer narrative. But when you balance out this market doing the loosening of financial conditions, not so much the Fed, other than, as you said, their forward projections, how does that also play into this whole recession fear that really seems to be on the back burner now?
Yeah, well, I think a lot of us, myself included, were in the camp that, monetary policy works with a lag. I mean, it's pretty reliably, 12 to 24-month lag, and that the rapid rising of interest rates and, quantitative tightening would play catalyst for a recession. I think we're still very close. There's a lot of signals that suggest we're very close in that regard. I think we're in a stagflationary environment right now, where the unemployment rate is starting to rise off of very low levels. The labor market is loosening, and inflation's remaining relatively high. Now, that is not at all what markets have priced. Markets have priced essentially a no landing now, where the economy stays very strong, doesn't even really slow down much, and inflation comes back to target, so that the Fed is allowed to lower interest rates in a dramatic way. Now, I think we're not in that sort of environment. I think that's not what's actually happening or likely to happen going forward. To me, I think that with break evens going higher, inflation surprising to the upside the last couple of months, that inflation's not going away, especially with this, like I said, the loosening of financial conditions and things, and the forward guidance from the Fed. Inflation's going to stick around, and it's going to not allow the Fed to loosen, I think, in the way that even the Fed is indicating right now. I mean, Jim Grant has said that they might have to, at some point later this year, start looking at rate hikes, undo all of this guidance towards cuts and start looking at hikes again. That's not something that markets are even considering right now. But at the same time, just maintaining rates at this elevated level, if the markets were to slow down, momentum, which has been driving the market, reverse in any meaningful way, then you could get that opposite effect, where a tightening of financial conditions driven by potentially a reversal in the stock market, widening of spreads, these types of things could bring the prospect of recession back on the radar.
Well, Jesse, another thing that people have been talking a lot about over the course of this year is where real interest rates, inflation-adjusted interest rates, are compared to where they've been historically. They're actually pretty high right now. And so a lot of people have messaged that the Fed needs to start cutting rates irregardless of inflation, just to narrow the gap between the Fed's fund rate, which is still up at 5.25 to 5.5%. And then you have inflation that's moderated some, creating positive real rates, which is usually a pressure cooker in the markets. What do you make of that argument that they have to start cutting rates just to square that circle a little bit?
Well, I think it's funny, because if you look at, let's just take the Fed funds rate less, CPI or core CPI or something, and, where are we at? We're like 2.5%, 3% or something, right? Even Arthur Burns, right, took the real Fed funds rate using that calculation above 5%, right? And that was in the mid 70s, and that wasn't enough to end inflation, the inflation problem. So to say that, Jay Powell has taken it 2.5 or 3, and that's too restrictive, given the kind of inflation problem that we have, is kind of silly when you look at it in a historical sense, beyond the past 10 or 15 years, right? I mean, even the Taylor rule and all these kinds of things would say that the Fed is still too easy, and the markets are telling you monetary policy is not restrictive right now, right? Stock market doesn't go up and spreads narrow in the way that they have over the last 6 months when monetary policy is restrictive. So markets are telling you monetary policy is not restrictive. But I will say that when you have a 30-year TIPS yield at 2%, right, that would normally be kind of commensurate with an earnings yield on the S&P 500 somewhere to, at least 6-7%, right? And we're at 4% on the earnings yield on the S&P 500. So the stock market right now is pricing a dramatic lowering of interest rates. We would need to see that the 30-year TIPS yield basically come back to zero to support stock prices where they are today. So you have this major disconnect between what's going on, I think, in the bond market and what's going on in the stock market. Yes, some of the markets have priced in fewer rate cuts this year, but the stock market generally is pricing in a much lower interest rate environment than we're in currently. And so that opens the door for a problem. If interest rates don't come down over the next 12, 18 months, and in a very meaningful way, it could cause real problems for stocks.
Yeah, we've seen those rate cut expectations all over the map, but in all fairness, heading into this year, I think weren't there 6 or 7 rate cuts almost priced in, and now the market moderating to that a little bit. But Jesse, make sense of this environment where we have U.S. markets at all-time highs, Bitcoin at all-time highs, gold at all-time highs, number of sectors within the markets, like the financials, like the energy ETFs. There are so many different all-time high areas that we can talk about. It just seems like, look, I guess everybody wants to have their money somewhere in the markets, but there's a lot of all-time highs happening right now.
Oh, absolutely. And like I said, that is the clearest evidence that you'll find that monetary policy is not restrictive. Look at back at the most restrictive monetary policy that we had, Paul Volcker in the 1980, 81, 82 timeframe, and everything was dramatically depressed. Everything was hitting 52-week lows, right? Stock market, bond market, everything. And that's what restrictive monetary policy looks like. I mean, that's right, an extreme, but this is not what restrictive policy looks like. And I think this is why we're starting to see some interest, finally pick up in the precious metal space. We're starting to see, I mean, the outflows from gold ETFs and things were just unbelievable over in recent months, even with, and we've talked about this for months, gold price hitting, new highs and ETF assets hitting lows, just people, abandoning the space. But I think with this shift in monetary policy, with this very clear shift that the Fed is no longer committed to a 2%, to a firm 2% target, that people are just starting to come around to the idea that, okay, wait a second, if the Fed is not going to assure us that inflation won't get out of hand again, we need to protect ourselves, and the best way to do that is by owning some gold.
Well, Jesse, talking about gold, we also talked a little bit off mic about the gold equities, and we've been asking forever, it seems like, different people on the show, why is there such a disconnect in the gold equities versus the gold price? And a lot of people have pointed to two areas. The stock market's doing good. To Corey's point, everything's hitting these new all-time highs. Sectors within the stock markets are hitting new all-time highs. Why would they want to gravitate into the gold or the gold equities? But gold has actually done pretty well. The other narrative has been the cryptos. The cryptos were stealing the thunder. When there was ETF outflows in gold and silver, there was all these ETF inflows on the new Bitcoin ETFs, and they said, hey, that's just basically money moving out of the gold sector into Bitcoin. Do we need to see either the cryptos or the general markets correct to bring more action into the gold equities?
I think we need to see the momentum space in the stock market reverse decisively. I think that's what, is attracting all the assets right now is just momentum. And so, I mean, you see it in everything. Like you mentioned, Bitcoin prices gather momentum, gathers assets. In the semiconductor space, we've seen, it go from NVIDIA to AMD and ARM and most recently Micron. And so money flows into the momentum space. At least it's what it's doing this year. So I think if we see a reversal in momentum, and I think we're getting really close to that, we're starting to see stocks like NVIDIA run out of steam here from a technical perspective. If we see that, then that will allow for potentially some more defensive sectors to gather interest. Like I said, it's not just the gold miners, which are, have some kind of defensive characteristics. There is zero interest. I think the allocation to defensives, I think it's something Callum Thomas has pointed out recently on Twitter, the allocation to defensive sectors like healthcare and staples is testing, record lows. There's just no interest in playing defense at all. It's just let's play the most aggressive form of offense that we can, which is let's buy 0-day to expiry options on these high-flying, semiconductor stocks. And so you see, like I mentioned the names, all the semiconductor names, see huge option volumes, and it's people, are just interested in buying lottery tickets on some of these most, the highest beta names in the market that they can find. Now, one of the indicators that we've talked about before, and I watch most closely is insider activity. The sell to buy ratio is literally off the charts. In over a decade worth of data, going back to 2012-ish, it's never been as high as it is now. And the previous peaks have always coincided with important stock market peaks. So the previous significant peak we saw was in November of 2021, when it hit this ratio of sell to buy hit about 40. We just went over 50 last week, and this is a 13-week rolling ratio for the total dollar value of sells to buys. So insiders are sending a very, very clear message here that there is little value to be found, few reasons to buy, and sell, a lot of reasons to sell. And you see, Mark Zuckerberg, Jeff Bezos, tons of these guys are unloading stock like they haven't done since 2021. So I think we're probably pretty close to a turn in momentum. And I think that would be the catalyst for people to start looking at defensives, looking at staples, healthcare, and gold miners again.
Is there anything gold miners or the gold sector can do broadly that could just change the narrative on them anyway, rather than kind of sitting around waiting for a bigger market correction?
I don't think there's anything they can do. I think markets are driven by narratives, and the narrative right now is AI is ushering a new era of productivity and profitability for all these tech companies. That's going to, be a new golden age for tech. I think that narrative, is quickly running into the reality of these companies are all having a very difficult time. They're spending a ton of money. The CapEx is through the roof, but they're having a difficult time monetizing that CapEx so far. And that reality is going to be play out in earnings over the next few quarters, and could be problematic for the short term, just like it was for the internet, right? The internet was the new thing, the new era, 99, 2000. And it was very difficult to find ways to make it profitable in the early days, which is why that bubble turned to bust in 2001 and 2. You just don't monetize it right away. And I think that's going to be the same thing for AI. Is we're going to see it difficult to monetize, and that when hype meets reality of the difficulties in profitability, you're going to see a major reversal in these things. So I think it's very similar to that time period, but it's also important to look back and okay, what did well then in 2001 and 2? Well, that was the beginning of a very important commodity super cycle that ran to 2008, 2011, whatever commodity you're looking at. And I think we're in a very similar period today. And I know I've been telling you guys this for the last couple of years, that we are in the early innings of a commodity super cycle, but that narrative isn't really going to resonate with investors until we start to see more things like the cocoa price, right, which is going through the roof. We see that in more commodities, and it becomes it just pounds investors over the head that, look, this is the risk to all these commodity prices is to the upside. And we're going to see more types of moves like that in a variety of commodities, just based on supply-demand dynamics and the fact that they've been so underinvested for so long.
Yeah, Jesse, you're not the only one that's mentioned the commodity supercycle on the show. And some people said that after the pandemic lockdowns, that it changed the global supply chain, and it changed the just-in-time manufacturing. And there's more of a national focus on securing their own mineral rights. That's why we now have critical minerals and strategic minerals, where before we just called them base metals. And we did see runs in lithium and uranium and iron ore. So there had been some early pops in some of the commodities. And you mentioned cocoa, but the other one that people are watching like a hawk is what's happening in the energy space. Obviously we had the big move in 2022 It was already happening before the Ukraine war, but that actually spiked it even more. There's been a big corrective move in the energy sector, but then lately the energy stocks have really been doing well, especially the larger producers, and oil's back above 80 again. I know you follow the energy space closely. What do you make of oil and the energy stocks?
Yeah, I think, oil's probably the most important one to keep an eye on. I've been watching the price of gasoline over the last couple of months because that's, both oil and gasoline prices are pretty good indicators of what inflation and interest rates are going to do going forward. And yeah, that we've seen a bottoming in the oil price and it turning higher. And that's simply product of supply and demand. I mean, obviously there's speculative positioning that goes along too. And at the lows in the oil price, I think we talked about this at the time, speculators were massively net short. And so that was a very good sign that they were just far too bearish. And demand, keeps hitting, keeps being revised upwards, right? They keep revising estimates of demand to new record highs. And so demand keeps surprising on the upside, and then supplies are relatively, restricted. We have OPEC Plus, which is, continuing to maintain cuts. And I think going forward that, U.S. producers are in a much different place than they were a decade ago. And they're not able to, now that most of the shale production is owned by the big players, they're not going to ramp up production in a way that the smaller players did every time oil prices picked up, in the past. And so, they'd ramp up supply and that would put a lid on prices. And I think these big players look at this as more like, no, we need these cash flows to last for a long time. So we're not going to ramp up production. We're going to just kind of be, slow and steady with production, which really changes the supply demand dynamic in a way that I don't think a lot of people appreciate. Not to mention that, the Permian, which is really the last area of growth in the whole shale arena, is potentially running out of that growth relatively soon. So I think, all of these factors go into supporting the idea that we're in a commodity super cycle and that inflation is not going to be tamed in the years ahead.
What about a quick comment on the U.S. dollar, too? Because the U.S. dollar has largely been range bound, but now it's been a bit stronger than a lot of analysts thought, at least through the early parts of this year, and currently holding just above about 104 on the dollar index. This whole loosening of financial conditions in the U.S. seems like it's also timing with other countries doing that because, again, the U.S. dollar relatively strong against other currencies. So how are you balancing out U.S. dollar moves?
I think generally we're still in a longer term dollar bear market. And that just goes back to the fiscal projections that, you look at the deficit, the trajectory of the deficit, and it's a pretty good driver. It looks like a pretty significant driver of the dollar. And so, if you think the deficit's going to narrow, you should be bullish. Generally, if you think the deficit's going to widen, fiscal deficit, you should probably err to the side of bearishness. Now, I think that probably the biggest driver of that in the short run would be recession. So if we're headed for a recession, right, that would not only widen the deficit, it would also turn the Fed even more dovish, and that would obviously be bearish for the dollar. So I think, the strength in the dollar goes along with this, the surprising strength in the U.S. economy. Things have held up well. And yeah, the Fed has kind of erred on the side of dovishness, but this loosening of financial conditions has helped the economy, support the economy, and support the dollar in the process. So I think that, your view on the economy is probably should be closely related to your view on the dollar because, if you see a recession in the months or quarters ahead, as I do, I think we're headed for, not another, financial crisis, super deep deflationary recession, but more of a stagflationary kind of period I think that's dollar bearish because it'll, the reduced tax revenues due to rising unemployment and things are going to widen the deficit. So I do think the dollar has been stronger than is probably justified, but that comes back to some of these things we've talked about, over the last several minutes. And so I think that going forward, if the economy is going to continue to slow down and we are going to see some kind of a stagflationary recession-y period, that will be dollar bearish.
Well, Jesse, when we look internationally, there are a lot of central banks that are, getting in front of the loosening policy as well. But there's also just some big changes that we haven't seen in a long time. The two that come to mind is Japan, for the very first time in 17 years, finally deciding to hike rates and get it out of the negative interest rate territory. And then the other beast of an economy is China, number 2 economy in the world. It's been in the hurt locker. Are people too bearish on China? What do you make of Japan and China's moves? How does that affect things in the U.S.? How does that affect global markets?
I think that, Japan, for one, surprised at, the yen weakness. Right. We have, frankly, I'm surprised, right? They make the biggest policy shift in, a generation. And we see, yen weaken on a hawkish shift. And clearly, markets were prepared for that. But it also suggests that, the Bank of Japan has room to even, get more hawkish, and they may need to support the currency. That's one that I'm watching closely, just because dollar yen does have, or the yen itself has some good close correlation with the silver price, and I would like to see some yen strength to get really bullish on silver. As for China, I do think people are too bearish on that economy. I think they're going to, they kind of have a slow and steady mentality that we don't need to kind of goose this thing, and we don't really want to. We want to try and work out this property mess over time. And if the economy continues trending and showing signs of recovery, that's going to be very bullish for the commodity space. I mean, I think we've seen China. I've seen a couple of analysts point to the hoarding of copper that's been going on in China. So clearly they're planning something. I mean, even if it's just, we want to make sure that we have, reserves of these things in an environment of high inflation. That could be all that's behind it. But it looks like, the Chinese economy is finding its footing, and going forward, that could be, very bullish for prices of everything from oil to copper, et cetera.
So final comment then, Jesse, as we look ahead throughout this year, what sort of data, what sort of events, what news do you think investors need to be watching for? What are you going to be watching for to confirm this narrative, this shift towards a more stagflationary environment?
I think it's going to be just investor attitudes towards inflation. And like I said, markets are the clearest indicator of monetary, restrictiveness. And so right now, the euphoria around AI is a clear suggestion that, monetary policy is not restrictive. I'm looking for signs that AI narrative is going to start to, and I'm already seeing them. That AI narrative is starting to become a little bit more sober, where people start to realize, okay, AI is cool, but it's not going to change the world today, and it's certainly not going to be profitable in a massive way for companies until they start kind of really figuring out how to use it a little better. And the inflation narrative is the other side of that, right? If we have a zero, a no landing priced into markets, I'm looking for narratives that will suggest people are saying, wait a second, maybe the economy is slowing down and inflation's, going to remain elevated. And I'm starting to see signs too in the last week or two that people are starting to look at the idea of stagflation. Now, markets haven't even begun to price that in. But I'm curious to see markets begin to price that in. It would kind of give some credence to that narrative.
All right, Jesse, thank you very much for your time. Again, Jesse is the founder and editor of the Felder Report, which we will link to below, and we'll be chatting with Jesse again next month. It's always fascinating to see what you're looking at within these markets and underneath the surface here, Jesse. Thank you very much for your time. I hope you have a great rest of your week.
Thanks, guys. You